Have you ever wondered what happens to a business if a partner decides to leave, retires, or unexpectedly passes away? The answer lies in an important document known as the buy-sell agreement. I'm Rozdeba, the CEO of Dundas Life. We're an insurance brokerage that specializes in insurance solutions for business owners in Canada. In today's video, we'll cover what makes this agreement not just important, but essential to your business. Don't forget to smash that like button and subscribe to our channel for more valuable content. Now imagine this: you own a thriving business. Suddenly, your business partner has a health crisis and can't continue to run it. What happens next? Does the business fall apart, or is there a plan in place to ensure its survival? That plan is what we call a buy-sell agreement, and it could be the key to securing your business's future. A buy-sell agreement is a legally binding contract between co-owners of a business that outlines what happens if one of the owners can no longer participate in the business. There are several types of buy-sell agreements, each tailored to different situations and needs. First, let's talk about cross-purchase agreements. This type of agreement is commonly used when there are only two partners. It allows the remaining partners to buy out the departing partner's shares. For instance, if a partner retires or passes away, the remaining partner purchases the shares, ensuring the continuity of ownership and decision-making. In a typical cross-purchase agreement, each owner takes out a life insurance policy on the other owner. If one owner passes away, the surviving owner uses the insurance proceeds to buy the deceased owner's share of the business from their estate. This approach not only ensures that the business remains in the hands of the surviving owner, but also provides the deceased owner's family with a fair value for their share. Now, cross-purchase agreements can become complex when there are multiple owners. Each owner would need to take out a life insurance policy on every other owner, leading to a web of policies that can be difficult to manage. This is where an entity purchase agreement, known as a stock redemption agreement, comes into play. An entity purchase agreement is more suited for businesses with multiple owners. In this step, the business itself buys back the departing owner's share. This is often funded by a life insurance policy owned by the business on each partner. When a partner leaves or passes away, the insurance payout is used to buy their share, ensuring a smooth transition. The entity purchase agreement simplifies the process for multiple owners because it avoids the need for each owner to take out multiple insurance policies on every other owner. Instead, the business holds a single policy for each owner, reducing the complexity and administrative burden. The third type is a wait-and-see agreement. This hybrid approach gives the business and the remaining owners the flexibility to decide at the time of the triggering event who will buy the shares, the business, or the individual partners. This type can be particularly useful in managing tax implications and cash flow concerns. The wait-and-see agreement allows for flexibility in determining the most advantageous way to handle the buyout. For example, if the business has sufficient cash reserves at the time of the event, it might be preferable for the business to buy back the shares. Alternatively, if the remaining owners are in a better financial situation, they might choose to purchase the shares personally. So why is a buy-sell agreement so important? It's all about the protection and planning. It protects the business from instability and ensures that the departing owner's family is compensated fairly. Without such an agreement, you could face legal battles, financial strain, and even the dissolution of your business. To set up a buy-sell agreement, you'll need to first determine the valuation method for the business. This can be done through a fixed price, a formula based on financial metrics, or an appraisal by a professional. Clear terms for the funding of the agreement are also crucial. Life insurance is often the funding mechanism of choice because it provides the liquidity needed at the exact time it's required. The valuation method sets the price at which the shares will be bought or sold. A fixed price might be easy to agree upon initially, but it needs regular updating to reflect the true value of the business. A formula-based approach, such as having a multiple of earnings or book value, can provide a more dynamic and accurate valuation. However, the most reliable method is often a professional appraisal, which ensures an unbiased assessment of the business's worth. Additionally, it's important to regularly review and update your buy-sell agreement. Changes in the business, ownership structure, or personal circumstances can all necessitate revisions to the agreement. Regular reviews ensure that the agreement remains relevant and effective. protecting both the business and the owner's interest. Consider the case of a family-owned restaurant. Without a buy-sell agreement, the sudden departure of one family member could lead to disputes over control and financial compensation, potentially tearing the family apart and jeopardizing the business. With a well-structured buy-sell agreement, the remaining family members can smoothly transition ownership and maintain the business's stability. Another example involves a technology company with multiple co-founders. As the business grows, so does the value of the shares. A buy-sell agreement ensures that if one founder leaves, the remaining founders can buy out their shares at a fair price, preventing external parties from gaining control and maintaining the company's vision. One unfortunate real-world story involves a successful small business that faced a crisis when one of the partners unexpectedly passed away. Without a buy-sell agreement in place, the surviving partner struggled with the deceased partner's family over the value and control of the business. This conflict drained resources and energy, ultimately leading to a decline in the business's performance. Now, a critical aspect of the buy-sell agreement is the funding mechanism. Life insurance is a popular choice because it provides a lump sum payment exactly when it's needed, upon the death of an owner. There are two types of life insurance used: term insurance and permanent insurance. Term insurance is affordable and provides coverage for a specific period, making it suitable for younger business owners who may not need lifelong coverage. Permanent insurance, such as whole life or universal life, is more expensive but builds cash and provides coverage for the business owner's entire life. This can be beneficial for older business owners or those who want a long-term solution. Funding the agreement properly is crucial to avoid financial strain on the business or the remaining owners. It's important to work with an insurance advisor that specializes in buy-sell agreements to choose the right type and amount of coverage to match the business's need. Click the link in the description to see how Dundas Life advisors can help you. Another vital component is triggering events outlined in the agreement. Common trigger events include the death, disability, retirement, or voluntary departure of an owner. Some agreements also cover divorce and bankruptcy of an owner, which can affect their share of the business. Clearly defining these events, ensuring that there's no ambiguity when the agreement needs to be activated. For example, if an owner becomes disabled and can no longer contribute to the business, the agreement should specify how their shares will be handled and how the buyout will be funded. This might involve disability insurance, in addition to the life insurance, providing the necessary funds to support the buyout. The agreement should also address the tax implications of the buyout. Depending on the structure of the agreement and the type of business entity, there can be significant tax consequences for both departing owners and the remaining owners. Working with a tax advisor can help minimize these impacts and ensure the agreement is structured in a tax-efficient manner. A buy-sell agreement is a vital tool to ensure that your business remains stable and your family is protected, no matter what the future holds. At Dundas Life, we're committed to helping you navigate these crucial aspects of your business. So, if you own a business, ask yourself, do you have a buy-sell agreement in place? If not, it's time to get started. Book a call with a licensed insurance advisor today by clicking on the link in the description below. Don't wait, time slots are booking up. Also, don't forget to like, share, and subscribe to Dundas Life for more insights into life insurance and financial planning. Until next time, this is Rozdeba, helping you secure your future one step at a time.